Hello, everybody. Welcome back to the 1ND podcast. I'm your host, Vikash, and I'm joined by my co-host, Sagar. And today, we're going to be talking about oil.
Yeah, and it's definitely something that's very interesting now as an economist for me, especially since we finally saw some first negative prices. And I'm sure you've been following the situation very closely because you've been trading those inverse oil and oil leveraged ETFs. So this episode will be more about me learning from you and asking you a bunch of questions because you've been following the situation really closely, and you actually predicted 3 weeks or 4 weeks before it happened that oil could go negative. So with that said, I'll let you open up the floor.
Right, so I've obviously been learning recently. I'm by no means an expert on oil. It's just something that piqued my interest recently, and I just started reading about it towards the end of last month, really. But I'm a very risk-averse type of guy, so I really like to learn about whatever I'm doing before I jump headfirst into it, especially when I'm trading the stocks for it. And so this podcast will mostly be around why oil fell, the whole oil situation. So, buckle up, get ready, because it's a little history lesson over here. So, obviously, oil prices fell recently. In fact, they fell so hard that they went negative for the first time ever. And that was truly historic that day because oil has never been negative. It's going to be talked about in the history books. And at the center of it all are Russia, Saudi Arabia, and the United States, obviously. And just to put it in perspective, oil has been on the stock market radar as a commodity since the late 1800s, and inflation has been 3,000%, and the S&P has risen over 30 million% since the late 1800s. And so it's kind of crazy that the fact that oil was actually cheaper now than it was in the late 1800s. Funny little tidbit for me over there. But I think one thing that people don't understand is how does oil actually go negative? How can the price of something like a commodity go into the negative numbers? And obviously, this doesn't mean that you can go on a drive and go and fill up your gas and the station will pay you money to fill your gas up. It's all about the contracts. And so producers are paying buyers to take supplies off their hands. There's so much oversupply and not enough demand that storage facilities are at or near capacity. So there are very few buyers of oil currently. And the price of oil is based off the contracts. The buyer buys the contract for the physical oil. They don't actually have the oil in their possession. And since the demand isn't there, when their contracts were coming up, the prices plummeted because nobody wanted to buy those contracts. Nobody wanted to buy the physical oil. And obviously the contracts were so hard to get rid of right at the expiry date that it made more sense to pay other people to store the oil due to the scarcity, essentially. And the cost of storing oil has risen so much so that to the point where people who own the contracts had to pay other people to store the oil. I hope that makes sense.
Yeah, that makes sense, especially given the fact that when you break this down as a simple economics problem, it's simply supply doesn't equal demand. You're thrown out of equilibrium. There's so much demand, and no one's leaving their houses or going to work, so the demand is obviously going to fall. And so when you think of oil, the actual oil you have does cost something, but you also have to factor in costs producing oil tankers, producing the drills that pump oil out of the ground. So all this extra cost to pump the oil is also at some point being factored in. And despite that, it went negative. I was looking at an interesting chart, and it showed the amount of oil tankers, large ships that are just off the coasts of major cities around the country, and it's an insane number. So what you have here are these ships loaded with oil, and if I read correctly, each ship, a daily cost to maintain, is $30,000. So if you have these oil pumpers and oil suppliers having to spend so much money just to hold it before they can sell it, then it makes sense why they're so desperate to get rid of it, because not only are they losing money drilling it out of the ground, they're also losing money trying to hold it and transport it somewhere where they can't because everything is full. So it's like one of those very rare situations where something's negative. Even like at a graduate level of economics, the existence of a negative price or like an inferior good, as some might call it, is very, very rare. Like it's not something many people even study on or learn about or try to pursue in research because of how really rare of an occurrence it is.
And you said that your professor even said that, some people asked what happens if the price goes negative. Your professor's like, that's a good question. You don't have to worry about that because it'll never happen.
Exactly. And I did a little research, and one of the interesting things is so resources are categorized into different things. One of the major ones is natural resources. So this could be stuff like natural gas, although it's not really natural, but electricity as another one. And fun fact is that some of these other big like monopoly style goods have also gone negative in the past. So there's a little bit of a trend there that, okay, we've had oil going to the negatives, we've had natural gas at one point going to the negatives, and we've also had electricity at one point going to the negatives. So there's really this like thing of these major things that people need. When the supply goes down, it's really takes a big toll, and it's definitely gonna be in the history books.
Oh, for sure. And later I'll talk about the fluctuation of prices in recent history and whatnot as well. But I actually thought of a good way to portray the negative oil situation. So think of it this way: I produce corn, and you, Sagar, you buy a contract for my corn, but you live in this little 1x2 Minecraft house, and you can't store the corn yourself. And that contract has an end date. You have to I'm giving you that corn one way or another. And so you have the rights to the corn. So since you don't have space to store that corn, you're having trouble to sell that corn to someone else. And that would cost you, and in your little 1x2 Minecraft house, it would cost you a ton of money to store it yourself. And so you would rather pay someone else to take it off your hands who has the capacity to store it than for you to find some way to store it, because it's actually cheaper for you to give it to someone else and to have to pay them to store it for you.
Yeah, and although it's kind of counterintuitive, if you think of it just in absolute prices, the amount it's costing someone just to hold on to it is, like you said, exceeding the cost they could potentially get from selling it. And in this case, they cannot sell it, so they're incurring the cost of holding it, which they don't have the capability to do, like in this case with a 1x2 Minecraft house. And the reason that they don't have space anymore is because the corn they already had contracts for is not sellable either, because the demand is simply not there. And it's very rare to see such a shift in demand, but Corona being so widespread and a global pandemic, it's like the worst case scenario that could lead to something like this intense of a shift, to the demand just absolutely tanking.
Right. So I guess the question now is, how did we get here? Right. So how did we get to these negative prices? What happened in recent history? And so that's sort of a long story, but here's what happened in recent history, right? This year, let's say. So back in March, OPEC was supposed to create a new deal since their old deal had ended. And OPEC is the cartel of around 15 oil-producing countries. And so in March, the demand for oil had started to fall because of the coronavirus. And this was pre-U.S. lockdown, it was mostly just China and Korea that were locking down at the time, but they were seeing a slowdown in demand. And so all of the slowdown was based off the oil consumption of Asian countries. And the demand for oil fell. And so the new deal needed to be made. And Russia was invited to this meeting because they're part of what's called OPEC Plus, which is essentially OPEC plus other countries, right? And so Saudi Arabia is the leader of OPEC and the leader of the cartel. And they wanted everyone to cut their production. And I don't have the greatest memory of the numbers that they wanted, but I believe it was like a 1 million per day, 1 million barrel per day cut at the time. And they wanted Russia to be the leader in the cuts. And Russia didn't actually want to make that move. And nobody really knows the reason why. Some people think that They wanted to hurt U.S. oil production because it costs more for the U.S. to produce oil, which I'll talk about later. Or maybe they wanted to gain a bigger market share, but the cuts seemed necessary at the time because demand was falling rapidly enough already. And that was in March before all the other countries started to uh, shut down. And so, since Russia didn't want to comply, Saudi Arabia they were like, "Heck, nah, we ain't playing like that." And so they were essentially the ones who started the price war, and they were selling oil at such a cheap price, even though, you know, every side will want to point fingers at one another to be the reason as to why the oil prices fell. Um, but within this time as well, the Saudis increased production by a ton. So they were essentially trying to increase their market share, trying to sell as much oil as they could, trying to take advantage of the situation. Not maybe not take advantage, but they were trying to teach Russia a lesson, essentially. So that was in March, and keep in mind, the price of oil has actually been falling since 2014, and that's when it was peak U.S. production. The U.S. became the number one producer of oil at that time, followed by Saudi Arabia and Russia. And back in 2014, the price of oil it was over $100 a barrel at the time, which is crazy high. Since that year, it went. I don't think it's reached over 75. I think it did it like once, and it's been like in the I think 40s to 60s range mostly, from 2014 to 2020 essentially. And so the U.S. actually greatly benefited from the deals that OPEC makes, since they're capping their production levels while the U.S. operates on a free market, so they just produce as much oil as they can. They produce as much as the demand is there. And so U.S. oil is much more expensive to make, like I said previously, than per barrel than Russia or Saudi Arabia. I don't have the actual numbers, but I'm pretty sure that's true. And shale oil is the reason the U.S. took over in oil production. It turned from an importer to an exporter within, I think, like 5 years, which is incredible. They became the number one exporter of oil. And I think I'll talk about fracking a little later too. But yeah, between 2014 and 2016, oil prices really fluctuated because when the U.S. started producing that much shale oil, Saudi Arabia and Russia were like, bruv, we could just produce more. You know, we could produce more oil for cheaper prices. And so they started selling a bunch of oil for dirt cheap, especially to, I think China was their number one country that they sold to.
Yeah,
And
just a quick question. What is a shale oil? Is that just offshore oil drilling?
shale oil, I think so. I don't know.
Okay.
Some type of U.S. oil, dude. Um, it's probably offshore oil drilling because that really took off, you know?
Yeah, that was definitely something that increased over the last half decade for sure. Like, the amount of offshore oil drilling has been crazy. I know, like, you're going to get into fracking, but in general, it's looked down upon just because of the environmental consequences it could have. But yeah, U.S. has definitely been trying to ramp up oil production, and it makes sense. And just a point you touched on earlier about the free market and how the U.S. would just pump and drill as much oil as they could. A reason they can do something like that is because of the type of good oil is. Oil is a necessity, right? Everyone needs oil to function in today's society. You need it for your car, just an example. So, how many percent of the workforce commuted to work, right? So, everyone there was using oil.
And oil is used to produce a lot of goods. Like, you wouldn't have hair clips, you wouldn't have Nintendo Switches, you wouldn't have water bottles without oil.
Exactly. So all this like demand was at such a high point, in terms of just the economy, that they could produce as much as they wanted because they knew that demand was always there. Because oil was one of those goods that would never run out of demand because of the fact that it's needed for basic function. It's not something like a luxury good or something where, oh, I bought a watch. Like, okay, you can buy a watch, but you do not need a watch to function day to day. And so in that case, that's why they were able to sustain such a high level of production. And the fact is that they had to have such a high level of production because we consumed that much oil. So when the demand shock occurred, and the supply was so outward shifted, it makes sense as to why things just slowly spiraled out of control until it went negative.
Facts, dude. And actually, in 2017, um, OPEC Plus, they decided to stop that mayhem of the oil prices going up and down because the demand was there. The demand kept increasing, and it just the price war was crazy back then because the U.S. kept producing more. Russia and Saudi Arabia were just selling it for so cheap, and so they decided to come up with a deal and cap their production. And because of that production cap, that's when the U.S. really thrived. Trump said he doesn't like the cartel, but they are the reason oil prices rose after that deal and cemented the U.S. as the number one oil producer, which obviously, you know that, man. Putin did not appreciate that. And maybe cemented isn't the right word since this current situation could shake up literally everything. Because of how expensive oil is to produce in the United States. But since oil prices were so high, they could justify producing that much oil at any time.
Yeah,
So
I mean, that makes sense. And again, when you have a fixed quantity of something, then you're essentially locking it as to where price is only dependent on your demand. And if demand is constantly rising, you're going to see increases in price.
facts. So then we see oil prices started falling. More and more countries go on lockdown, and the demand for oil keeps tanking. Get it? Tanking. But yeah, Big Orange DT. He realized he need to coordinate something with the cartels. One thing that even he probably didn't even think he had to do, because he said he hated the cartels. But hey, there he is. He got the dice rolling on some sort of cut just by him announcing that he talked about oil cuts to Putin and Mohammed bin Salman. The price of oil rose by 25% in a single day, I believe, which is unprecedented. That sort of market action does not happen in the case of a rise, at least. Nonetheless, he was able to coordinate an OPEC Plus meeting to cut oil production, and that's his business acumen coming forward, and you got to give him props for that. And then, funnily enough, this deal hit a snag because I believe it was supposed to happen on a Sunday, the OPEC Plus meeting, or Saturday, something like that. But Saudi Arabia and Russia started saying, oh, they started this. They started pointing fingers at one another, and they were pointing fingers as to who started the whole ordeal. And that actually postponed the OPEC Plus meeting, which I thought was hilarious. And so, on the day of the deal, whenever after the postponement date, OPEC Plus seemed to be on the page the whole time. Everyone wanted to cut production because they saw the demand was falling hard. And most news that was coming out of the meeting, obviously, like, the meeting wasn't public or anything, but there was news coming out of it. It seemed like the deal was ready to be made. And obviously, it hit a snag at the end of the day. Mexico said that they didn't want to participate in any of the cuts. And it's because the president of Mexico made it his mission to reach a certain number for production in oil, and he did not want to cut. Even though, dude, they're losing a ton of money because it cost them a lot to produce oil, but they wanted to, they insisted that they didn't want to be part of the cuts. And
Now,
so
I was reading something about that. Is there any validity to the argument some people were making that Mexico was essentially hedging against oil? So they were essentially covered from potential losses because of their hedge?
how would they hedge it?
I'm not sure. I don't remember the details of an article, but there were some articles stating that Mexico had hedged against oil a month ago, and that may be a reason why they're reluctant to have cuts. But again, I'm sure that they're just trying to make reason of why they would want to not cut production, because not cutting production makes no sense. So maybe these are just articles trying to justify why they.
Possibly.
Yeah, but there was some speculation out there about them hedging against oil so that in the case it fell, they would not be as bad off.
I don't think that's true because what I was seeing personally is that it cost Mexico. I think their break even point is $30 a barrel, so it had already been below $30 for a while, and like I said, the president of Mexico, he really wants to be one of the global leaders in oil production. I mean, he'll never get to the level of the United States or Saudi Arabia or Russia, but he wants to get up there. He wants to increase that so that they can be a better oil exporter. And I believe that was literally the only reason, because they're not cutting production. So I don't know how they could have hedged anything. But, I don't claim to be an expert on the situation. So this is just what I, recall from the whole thing. Um, in my perspective, they were trying to game the system, essentially. Like, they wanted no cuts for themselves, but they wanted everyone else to cut. So they essentially were like, yeah, we only have, I think they wanted them to cut, I don't know, 400,000 barrels per day. And they believed that they could abstain from it, that they could be free from it because everyone else seemed to want it so bad, and that everyone else would cut, and then they wouldn't have to, and then it would lead to higher oil prices, and then they would be in the win-win situation where they didn't cut and they get higher prices for oil.
Yeah, so just a little tidbits. Reuters was reporting that Mexico had a hedge against oil, and that their payout. This is as of April 22nd. They're getting a $6 billion oil hedge payout.
Oh, so I think what that is referring to is that the government is paying the oil company that produces all of Mexico's oil
Okay, that's interesting. Okay, that makes sense.
to give them more leeway so that they can continue to operate, because they have not been profitable in years. So I believe that's what that's talking about, but I'm not sure.
Okay, I mean that would be something. So that's what I was reading about essentially. And they've hedged oil in the past, but this is their biggest payout in history.
I think that's exactly. I think I remember seeing that as well. I think that's exactly what it is. The government's just bailing out that oil company. I forget what the oil company's called, but yeah, I think that's what it was. But yeah, so the OPEC Plus meeting, it ended without a true deal, but I don't think it was ever going to end without a deal. I mean, I don't think it was going to end with a deal regardless, because the G20 summit was the next day, where all the non-OPEC countries would convene and, with OPEC countries like Saudi Arabia, and talk about their cuts, because considering like it would not be fair that OPEC Plus cuts and then countries like the United States, Canada, Brazil, that they didn't cut, right? And so the G20 summit comes the day after, and considering the markets in which the non-OPEC countries operated in, they could not demand oil cuts. Like, Donald Trump cannot just say, "Hey, we're cutting 1 million barrels per day," because it's a free market. But what Donald can do is talk to the CEOs to try and get a solution going, because it's in the best interest of everybody to comply with these cuts. So many countries before the OPEC Plus meeting, they were saying that their cuts would come in way of the oil prices falling, so the cuts would come naturally because production will fall as oil prices fell. But apparently, I think they eventually gave a number to Saudi Arabia, and Saudi Arabia was happy with it. Everybody else was happy with it. And Trump even covered most of the cuts that Mexico was supposed to make so that the deal could be finished. He also said Mexico will pay them back in term, not in oil, but in terms of, other goods somehow. Whatever they came up with. I don't really know the specifics. Actually, I don't think Donald knows the specifics either, because he never mentioned it. So yeah, the OPEC Plus deal finished officially, and they announced that it would be around 10 million barrels per day. It would be a 10 million barrel per day cut starting May 1st, right? And so everyone was happy. Everyone was all hunky-dory. They were all expecting the price of oil to rise, just as it did when Trump made his initial tweet. But that never came. It was like, it didn't even rise a bit. And I think it was because people started to be wise to the fact that the cuts wouldn't even be close to fixing the loss in global demand, and it seemed too little and too late. And, all these countries started saying, oh, but the cuts are actually more going to be like 20 million barrels per day, not 10 million barrels per day. And, they're trying to cover everything. And, it's Trump even tried his best to tweet out, raise the prices of oil, but that didn't even work this time. So they did stay stagnant for a while after the OPEC Plus meeting. It didn't go up. It didn't go down very much. It went down, but not by too much. Until the May contracts came to an end, which was earlier this week, and we all saw what happened. Everything went down the gutter, and essentially that's the entire oil situation. That's how the oil price got into the negative numbers, and now the countries want to move up the date of the oil cuts because they were supposed to start on May 1st, and it's still April and it went to negative. But at this point the demand is so low that they'd have to have some crazy cuts to fix the oil prices. I mean, the oil prices have rebounded. I think now they're on the June contracts, and no, they're still operating on May contracts, but the June contracts are rising. The May contracts are rising. I think the May contracts are back to $10 a barrel. But actually, they're slightly under $10 a barrel. But that is the oil situation. I can go into some anecdotal, situations as to what I did in the stock market during this time. But yeah, what do you think of this whole situation, dude? Kind of crazy.
I mean, it's crazy. As an economist, again, you never study about these kind of things. But when you rationalize it, it makes sense of why it goes into the negative. If you think of it in like simple layman's terms, you can understand, okay, simple logic would show that if there's so much of it and no one wants to buy it, then at some point when you have so much, you have to pay people to get rid of it. I'll also say that, yeah, there's definitely some good market moves you could do in situations like this. I mean, you've had some experience with that, trading some leverage stocks. I'm sure you want to get into that a little bit.
Oh, for sure.
I've definitely profited a little bit off of those stocks as well. Again, it's a very crazy time, right? So even these stocks which are leveraged don't necessarily match up anymore because of how volatile the market is. So I think it's good to know that whenever you try to apply all this information during this volatile time, there's going to be a large level of risk involved, and things that say they're leveraged at a certain point may not be in the future just because of the fact that the price is moving so much. For example, like that you said about the unprecedented move of oil up 25% in a single day, right? Like that never happened before. So those kind of things need to be accounted for, and you really need to understand the situation before you try to invest in something like this. And hopefully your explanation of the last month of events is going to help people try to invest smartly.
Yeah, and one thing I would recommend is to learn the underlying contracts of these leveraged ETFs and ETNs and anything like that, because originally I didn't understand it. I was learning the oil situation. I thought I had it on, down packed, but there were times in which I bought into some stocks and it didn't pan out the way I expected it to. And so let me just go through my thought process in the stock market off of the news that I was reading. And so originally I was into Gush and Drip. Actually, I never bought any Gush, but those are the two ETFs that track oil exploration, I believe. And so I made a good amount from Drip because it is inverse oil expansion at the time. But then then I think Gush had a stock split of some sort. I believe it was a reverse stock split. And once that happened, the correlations were slightly weird. I moved on afterwards anyway, like in between that time, to DWT and UWT, which tracked oil prices more closely. But then I made just a small amount from those, even though I was up big on DWT at one point. I then lost most of those gains afterwards because the leverage just lost it just became unbalanced towards the end of its life cycle, and now it's like untradeable at this point. And so finally I moved to SCO and UCO. Those are Bloomberg double leverage ETFs that track crude oil, and that's where I've made a bulk of my money in the last month. In that, when I was reading that oil demand was going down, I was into inverse oil, SCO, and I made a good bit off of that. And then the week that Donald Trump announced that he was in talks with Saudi Arabia and Russia, I was actually in SCO. And so right when he tweeted, I'm so glad I had that stop loss in place, because if I didn't, I would have lost so much money I would have gone into the, I wouldn't have been profitable on that stock at that time. And so I lost around 50% of my gains from that single tweet alone, which was annoying. But then it like showed me, hey, Donald Trump tweeted that there's a deal that's going into place. Maybe the actual deal coming into place will actually, raise it even more. And so I was in UCO when the deal was going through because I knew it was going to go through. It was bound to happen because the whole world needed it to go through. And I was wrong. Obviously, the stock price did not rise. And actually, during that meeting, I was 50-50 within UCO and SCO so that I could play either way and have some sort of position in it so that I can be ready. But SCO actually hit my stop loss, and then I went into UCO, which then went down. So I was net negative on that trade, but ever since then, I was in SCO. And the day oil prices went into negatives, I was in SCO. It rose a good amount, 15-20%, right? And I was happy, but then the oil price kept falling, yet SCO was not rising. It was actually falling when I was holding it, and somehow it hit my stop loss. And while the price of oil was going into the negatives, it hit my stop loss. So I'm like, all right, this is not correlating. I don't know why. And it sold. And I'm like, I'm not even going to buy back in because if it's not correlating, I think this thing is broken. Well, the next day happened.
Yeah, and the next day that went up an insane amount.
It was up at, I think, 80% at one point.
Oh my goodness.
I had let me tell you, I had a bag in SCO, dude. I could have made so much money. Over 10K on that trade. Man. Alone. Easily over 10K. But I didn't. Alas, I mean, I'm happy with the 2K gain, right? Mm-hmm. And then recently, I bought the rebound of oil in UCO because I believe the prices just went down. Oh, and one thing to know is the underlying contracts that these are traded off of. UCO, SCO, they're traded off of June contracts. DTO, whatever the inverse is, DBO or something. Those are June contracts too. They're not based off the May contracts. But because the May contracts tanked so hard, it impacted the price of the June contracts on Tuesday. For some reason, it didn't impact it on Monday when the price actually happened. Still salty. I'm very salty about it. But, it is what it is. And stuff happens. Green is green. I'll move forward. But yeah, right now I'm playing the rebound. I got into UCO around 13. I sold at 15. Now I'm back in at 17 because I bought in today. Small position. I think like 100 shares maybe. And hopefully it's already gone up since then, but I think it'll go up even more just because of the correction that's going to happen to the June contracts because it went down so much as a reaction to the May contracts. And so knowing the situation, knowing the underlying contracts for these ETFs and ETNs, it can really be profitable. And now I'm into options, and so I'm still not confident in it. I'm not gonna put a bag into some UCO or SCO option, but I'm playing around with it, and we'll see how it goes. And with options, the possibilities are endless with options. So we'll see how they go.
Yeah, for sure. And options are definitely something I'm trying to get into as well now. So let's say you're someone who wants to take advantage of this market, right? And seeing prices fall. What do you think would be a good way to invest in oil since inevitably, be it like 6 months down the road, a year down the road, 5 years down the road, oil prices are going to rise, right? When Corona has settled down. So if you were someone who was looking for a long position in oil, what do you think would be the move?
See, a lot of people have asked me that, but I've been so focused in these leverage ETFs and ETNs that I don't actually know. Because I don't want to recommend, like, let's say I tell them UCO. Exactly. That's a leveraged ETF. And if oil were to tank again, if the price of the June contracts were to tank to, let's say, like, negative 50, then the price of UCO will go down so much to the point where you could buy it at 15 and it'll go down to 10 cents. And then it'll have some reverse stock split, but you're still down so much money. And then it could rise 100%. let's say it went down to $1. That, because of the nature of ETFs and ETNs and how they reset every day, if it goes down from 10 to 1 and then it rises 100% from 1 to 2, you're still down. You're still down a substantial amount.
Yeah, you're down a lot of money. So it's always risky with those kind of things.
It's
So
definitely
again,
tough.
it requires like research, and you need to know before you get into a position. But
Yeah,
there's definitely opportunities right now to get in and make some profit.
definitely. And, I'll research it. I'll figure it out. We'll see what happens. If I figure something out, maybe I'll say it in a future podcast. But right now, as of this moment, I don't know. Actually, other soccer asked me that question too. What what oil stock should he invest in for 1 year from now? And that's a fair question, right? Everyone wants to do it right now, but it's just tough with leverage ETFs.
Mm-hmm.
There are non-leveraged, like there are 1x ETFs that just track the price of oil. I just don't know the names of them, and I'd actually recommend those, right? Because maybe not. I don't know. I don't want to say anything definitively right now. I don't want to.
Yeah,
give
and
bad
again,
advice.
like if like one of the best tips is that when you get a recommendation for a stock, don't simply buy just off a recommendation. You still need to do your own due diligence, understand the stock, understand the market, and make sure that the level of risk you're taking is something you can afford, and that there's a equal or greater opportunity for a reward for the risk you're taking. So I think that's a good rule for when you're trading.
Never trade off of someone else's word.
Yeah.
Always, it's best to just learn what you're trading so that you have confidence in it. You know how to trade it. Like, you could buy something at $50 that goes down to 40, and you're like, oh no, I'm gonna sell right now. I don't want to lose more money, and then it rises to 100, right? And that's just because you don't understand how the stock's moving. You don't know how stocks work. You don't know how, the movement of the stock will be in the future, and if this is expected behavior or not. It's good to start learning how to read charts, how to read commodities, learn what's happening, what's going to happen in the future. And, it's made me a decent bit of money already. And that's just been in the last month and a half. And I just came back into the stock market because obviously I was trying to make a automatic stock bot. But this volatility is just too good of an opportunity to pass up. But yes, definitely learn what you're trading. But another thing I wanted to talk about, and so this is not based off research or anything.
There's a reminder for Bakash.
Oops, that was Google. So one thing to look at is the price of natural gas, right? So a lot of natural gas, it comes from fracking, which is the most expensive form of oil production. And since the demand is still falling, and production cuts will have to come, you have to think that fracking will take a big hit because they are the most expensive. So that would mean natural gas production would be lower. Demand would be, demand for natural gas is actually going to not drop as far as oil because we're still in our houses. We still need, heat and things of that nature. And so by the time winter arrives, we're going to have this lower supply and minimal impact to demand. And so as an economist, wouldn't you agree that that would result in a skyrocketing price of natural gas?
Yeah, I mean, that's definitely an interesting take. So in that case, you'd want to trade those and definitely follow the situation on that.
And I'm just saying in general. So follow the situation, figure it out. That's just a hypothesis of mine. I don't know for sure.
Yeah.
But, it's fun for you guys, not fun for you guys, because that would mean warming your houses will become super expensive if winter comes and this actually plays out. If winter comes, winter's coming, obviously, but if this sort of situation were to play out, the cost of living in general, just due to natural gas, I don't know, stock up on that fireplace stuff.
Yeah, luckily we live in Florida, so we wouldn't have to worry too much about that.
Yeah, dude.
But other than that, yeah, I mean, again, like these are unprecedented times. The markets are so volatile, but what that means is that there's opportunity for you guys and for us to take advantage and make some money.
Yeah, dude. I mean, on the topic of the stock market, I mean, I'm all oil and natural gassed out, right? But
yeah,
just since we're on the stock market talk, it's completely unrelated. But in my opinion, I think Shopify could be our era's Amazon. Thoughts?
You think Shopify? Interesting. Okay. If I'm not mistaken, isn't Shopify what a lot of dropshippers use for their online business?
It's the go-to place for e-commerce. If you want to start your own e-commerce store, you go to Shopify.
I think that has a lot of validity because, given the like what people want to do this generation, at least in the United States, and I'm sure around the world, is take charge of their own like career path and start their own businesses. So I think if public perception leans towards people wanting to start their own business over taking a salaried position, and that we're generating more business through independent, local, and small individuals taking over, then yeah, I think a major shift in the way the economy works, Shopify would definitely be the next Amazon. So I think there's some validity to that. Yeah.
You got to think about how big that e-commerce market is. Like, yes, Amazon is basically a direct competitor, but the reason I like Shopify, much like Amazon and Google, they are a platform, right? So they don't necessarily rely on their own content to succeed. Amazon, they have so many sellers. Google, they they just are an aggregate of everything on the internet. And obviously that's not the only thing that they do, but you have to think Shopify will also expand in the future. Shopify's share price is already fairly high. I think it's at $600 something. But if you take into account Amazon and how big they've gotten, obviously I don't think they'll get to the same level as Amazon. Amazon is $2,500 a share after stock splits. Like, think about that. They've had such high share prices that they've had to do stock splits.
Yeah, no, Amazon is insane. And again, Amazon is so dominant in the marketplace. If Shopify, I think they do have potential, like, to get to that level. So
Right.
You are right about that.
So like, think about that back to the platform idea. So they essentially have cornered the e-commerce platform in terms of anyone who wants to start and enter their own business. Like, they make a lot of money for a reason, right? So they take a percentage of sales, and dude, I think 10 years from now, yeah, $600 may be a lot of money for the share price, and I think it's due for a correction in the near future. But 10 years from now, $600 might be minuscule,
I mean, if you think about it, I was apprehensive to trade Chipotle stock when it was like $150, and now that stock is like reaching insane level of prices as well. I don't know the current stock price of it's $867.
Wow.
So I could have bought in at 150, and that may sound like a lot per share, but over like the last year and a half, you're making 500-600%. Like, those are insane returns for those kind of stocks. So again, that leads another topic. Like, if certain share prices are falling, like restaurant industry stocks are falling because of the coronavirus, then those may be a good thing to invest in too. Because when restaurants rebound, that chains like Chipotle, which already have such a big market cap, are not going to go out of business. You could make some good money when they rebound and Corona is settled down. So again, there's so many opportunities you could try to take advantage of in this market.
Right. And I think I think it'll be fair to have a stock market podcast in the future. Our ideas, what we think of the current market, things that we think are going to happen. Obviously, we don't know what's going to happen. This market is crazy, but we love talking about stock market, so we can go on. We can have multiple podcasts about that.
Yeah, for sure. And let us know if you guys like these kind of podcasts where we're talking more about like markets and what we think and some cool stocks to get into. It's definitely something that interests us, and we hope you guys are interested in it as well.
Yeah, dude. Anything else?
I think that covers it. This was more of your time to shine with oil, for sure. And definitely look forward to more podcasts. Once again, we will be uploading more frequently since our schedules have settled down a little more and we're back into like a consistent flow of things. So do be expecting more. And once again, we will be on all the platforms you could think of and YouTube now. So if you have any comments or feedback, please do leave us any feedback, comments you have, and we could try incorporating them into our future podcasts.
Yeah. And with that, that is the end of the 1ND podcast. Thank you all for listening, and we will see you later.
Peace.